Hi, in this very video, I would like to talk about responsibility accounting. So cost center, profit center, revenue center, investment center. I've been teaching for like 30 sessions already, and this means that I have had 500, maybe more students in APM. And as my tutorship approach is that students do the work and then they send it to me for review and they comment that, I know the misconceptions that they have. And trust me, this responsibility accounting is one of the topics that is the hardest for students. So let us discuss that. When we talk about responsibility accounting, we talk about the types of KPIs that are going to be set to your divisions or departments that you want to control. So imagine you're located in London and you have a division that is in Sydney. And we want to set KPIs so that we do not need to do this micromanagement, so that we do not need to approve each and every decision. We just say, okay, guys, you have your brains. Well, HR department has recruited you, so you know what you are doing. And I will just set these KPIs to ensure that you are actually acting functionally, not dysfunctionally. So this is actually the example of an example from the file that my students get. So we have short pieces of theory, and then we have quizzes and so on. So I will be talking on the basis of it, and I will close the navigation so that you can enjoy greater view. Okay, so what about this responsibility accounting? Well, we will look at the center and try to think about whether they can control revenue or not. If they cannot control revenue, and this may happen if, for example, we have a production facility, and this production facility does not talk to clients, they cannot influence prices, they cannot influence quantities. As such, they do not control revenue, and they will be treated as cost centers. What does it mean? It means that we are going to evaluate the performance based on measures such as, let's say, total cost, or let's say idle time, or let's say productivity, some sort of productivity, for example, items produced per unit. So something that does not include revenue. So gross profit or operating profit would not be a very good measure in this very case because they do not control their revenue. They do not really control their volumes. But what if they can control revenue? Well, in this case, we need to ask question whether they can or cannot control investment. If they cannot control investment, and investment means the changes in non-current assets, such as the purchase of fixed assets. Well, major fixed assets, of course, not, let's say, tables or computers, but maybe a piece of machinery. Control investment means the ability to buy intangible assets. So, for example, licenses. So something that is quite expensive. And if this division cannot control their investment, they will be treated either profit center or revenue center. They will be treated as revenue center if they can control revenues, but they cannot control costs. But, well, the example of this could be, let's say, if we are a producer of cars, let's say Volkswagen, and we have a reseller, so we have a car dealer, and they cannot control costs, but they can control the prices and the volume. So we will evaluate them based on revenues. However, it may as well be that they can control both of them, and we will be able to evaluate them based on profits. So we will treat them as profit centers. And if they're profit centers, we would need some measures as, let's say, net profit, operating profit margin, something like that. It may as well be that they can control investment. And if they can control investment, we are going to ask them, hey guys, have you utilized your investment effectively and efficiently? And as such, we are going to measure NPV, residual income, return on investment, something like that. And this is the base case of this very subject. However, from the point of view of advanced performance management, you will need to look at this topic a little bit deeper. So, for example, we have a research and development department. And if this is a research and development department that, let's say, invents the flavors of ice cream, and we know that they have to be invented, we have to change the flavors, but there is no rush. We do not need any breakthrough. So what does it mean? It means that we would control this research and development department as cost center. So we will control, let's say, total cost, total labor cost, or idle time, or whatever. Because that is the easiest way to manage the department, because you just look at cost, at expenses, and this is just a single item, and they do not depend on revenues and so on. So that is the easiest. And you kind of motivate them to look at budget deviation. So you say, okay, guys, so you have always spent your budget by, let's say, $100,000. So now you have that as a target and you can keep your focus. But what if we really need research and development department to brainstorm with new ideas so that we could be ahead of our competitors? What if, let's say, we produce some electronics and we need to come up with new models? We need to be ahead of the market. So we need to motivate this research and development department to work faster, to provide us more output or better quality of output. So we say, okay, guys, we are going to introduce some sort of a transfer price. Transfer price is the price that is going to be charged quite often nominally, so no cash is going to be transferred, but it's just going to be accounted in our books, in our spreadsheets. And every time another department, manufacturing department, gets your research and development results and they utilize that, we are going to record that as revenue. So when you work, you will be motivated to produce more, and you will be motivated to think about final customer, because if final customer will like this project, then the purchasing departments, those the manufacturers, they are going to want to buy this research and development from you, and as such, your profit-based KPI is going to increase. So they are going to be profit centers. They're going to be set as profit centers, even though naturally they would be treated as a cost center. But hey, we have a research and development department that needs to spend lots of time on getting approval from head office to buy extra equipment or a license or whatever. And head office does not really understand the stuff, because this research and development department, let's say, is engaged in pharmaceutical stuff or bioengineering or whatever. So what do we say? Well, we say, okay, guys, we do not really want to suffer with all those tables and calculations. How about you make these decisions on whether you indeed need this intangible asset or not on your own? And we will just check that you utilize your investment wisely. So we are going to treat you as investment center. So we will alter your KPIs to include this NPV, residual income, return on investment, and you will be able to get these investments in non-current assets without any further approval. So your manager is going to be the final approval, and we are going to see whether you manage to pay back the investment or not. So see, it's actually the other way around. This investment center, profit center, revenue center, and cost center, these are the names that actually derive from the type of metrics that we're using. We cannot say that we are going to use a net profit for cost center, because if you're using net profit, then this means that you are evaluating that department as profit center, because net profit is a profit-based measure because it includes revenues and costs. Also, what is important to acknowledge is that profit centers are harder to account for compared to cost centers, and investment centers are harder to manage than profit centers because there are just more variables to look at, to monitor. And as such, you cannot recommend each and every department to be investment centers, as I know many of you do. No, because we need to balance this cost versus benefit. And also, we want to be very efficient. And if the scenario says that the department overspent their budget, that they had adverse variances, maybe we need to set them as cost centers so that they deal with these operations first, and then they can be treated as profit center. Not now, not in the forthcoming year, because if we make them profit center, they will just ignore the fact that they are not efficient. I will start chasing profit, and this actually can backfire if they boost their operations, increase the volumes, but the processes will still be sloppy. Another thing is that the types of metrics are very important based the way we set types of metrics should include the consideration of the stage of the product. So let's say if we have a product that has just been launched, it would be very dysfunctional to treat this project, this department, as profit center, because they have just launched. They have not been able to utilize the economy of scale because they do not have enough clients to pay back for their fixed costs. They need to spend lots of money on marketing, on research and development. So it is expected that they're going to have losses or that their profits are going to be minimal. As such, we cannot make them profit center. Instead, we need to make them revenue centers. We need to measure them based on the quantity of clients increase, based on, let's say, revenue increase, not on profits. And if this is a mature department, well, maybe we want to treat them as profit center because we want to make sure that they can pay back their costs. We do not really want to treat them as investment center because if department is mature, then it is unlikely that they need some major innovations. It may be. We will look into the scenario, but quite often it's not the case. And if we know that the project is done, well, naturally done, and there is nothing we can do about that, then we cannot treat this department as profit center because it will demotivate managers, seeing that their profit, their main KPI, is falling each year by, let's say, 1%. That is natural, and that is not something that we need to measure the performance of the managers for. So we would set them as cost centers, not profit centers, not revenue centers, not investment centers. Okay. So once again, these names, cost center, profit center, revenue center, investment center, the names actually derive from the types of metrics that we are going to use. And the types of metrics that we are going to use depends on whether departments can control revenues, costs, and their investments. And what is the stage? What is that we want to motivate? And what is that can be demotivational? And yes, this topic is still confusing and is still tricky. And that's why I really encourage you to do these quizzes. And quizzes are short pieces of scenario that takes about 15 to 20 minutes for you to answer. It's not task, that's a scenario. And from that, I'm able to see how you make your discussion, whether you have misconceptions or not, and that improves your chances of passing exam. So please contact me and let's make these quizzes together. You will love that.